Yo, it's your boy Felix, and welcome back to another interesting episode on Top of FX. And today I'll be analyzing the Bitcoin against the US dollars. So, without further ado, let's jump right into the chart. So, the first thing always whenever I'm analyzing an asset is to try to get the direction of the market. And one of the ways I do so is by going to the highest time frame. So, anything from the daily down to the monthly are all considered a higher time frame. The reason why I do that is because this is where institutional traders such as the banks, large financial investors, and all these guys that trade billions of dollars on a daily basis, this is where they look at. So it would be a good idea to pay attention to the time frame day trade phases you can see the market. The first phase is either the market is making an uptrend, so the market is making higher highs, higher lows, or the market is making lower lows, lower highs, so that's a downtrend, or the market is moving within a range. In this case, the market has been making higher highs, higher lows from since 2016 thereabouts. So it has been making higher highs, higher lows. So then we're in an uptrend because this is a high, a low. It was a high down here, a low, a high, a low, and a high. So it's making higher highs, higher lows. In this case, we are in an uptrend because the market is making higher highs, higher lows. Whenever I hear the word trend, always picture a 5-wave pattern. So if this is an uptrend, what to expect a 5-wave pattern. What to expect the market to unfold in a 5-wave pattern. So an uptrend makes higher highs, higher lows, and it does so in the 5-wave pattern. This first wave, second wave, third wave, fourth, and fifth are considered fractals of the market. And also within this first wave, you can also get another 5-wave pattern. Down here also you can also get 5-wave pattern, and this a 5-wave pattern. So notice how I only drew a 5-wave pattern for wave 1, wave 3, and wave 5. The reason why I did that is because this wave move in direction of the trend. So it is an uptrend, so what expects a 5-wave pattern for any wave that move in direction of the trend. But for the wave that move against the trend, which are wave 2 and wave 4, we are to expect a 3-wave pattern within it. So there's an A, B, C, and this is A, B, C. So the next idea now is to implement what I drew here on this chart. So already I could say this was the first wave. You could see this massive move upward. It got to this high and a retracement. So this is the first wave and the second wave. Then the next, after the second wave, what comes next is the third wave, where we could see the fractals of the third wave, where this is the first wave, the second, the third, the fourth, and the fifth. And what comes next is the fourth wave and the fifth wave. So I'm going to draw the whole wave pattern so you can see it properly. This is the first wave, the second wave, the third wave, the fourth wave, and the fifth wave. So guys, so I've been able to get the first, the second, the third, the fourth, and fifth. So guys, after a 5-wave pattern, there are two possibilities that comes next. Either you get a retracement or you get a reversal. A reversal will lead to the break of this whole structure, so this whole thing. So for a reversal, what to expect will be a 5-wave pattern. So meaning a reversal means like a change of trend. So we'll move from an uptrend to a downtrend. So a reversal is gonna be this 1, 2, 3, 4, 5. So that means it will lead to the break of this entire structure, and that will mean the Bitcoin has crashed completely. The second scenario is a retracement, which is just a 3-wave pattern, which is an A, B, C pattern, and at the end of this A, B, C pattern. What comes next is a continuation of the previous trend, which is an uptrend. So which is a continuation of the first, second, third, fourth, fifth, and it will lead to the break of this upper structure. That is a retracement. So a retracement is a three-wave pattern, but it doesn't lead to the break of the entire structure. Instead, it leads to a continuation of the previous trend, which is an uptrend, and the reversal leads to the break of the whole structure. But in this case, I will treat this market as a retracement because I hope that the Bitcoin doesn't crash. But regardless, you can still make money either way. It's about you not being greedy with your analysis and knowing where to take your profits. So in this case, if I treat this market as a retracement, where this is an A, B, C. So the next thing I'm going to do right now will be to dissect this retracement or the correction, which is an ABC pattern. And from my illustration, from what I illustrated in the drawings, I said the A wave could either be a three-wave pattern or a five-wave pattern. The B wave is always a three-wave pattern, and the C wave is always a five-wave pattern. I will be going down to the lower time frame in order to see the candlestick properly and to be able to count the fractals easily. So I'll be going down to the daily time frame, and I'll first start by dissecting the A wave. So the A wave, what to expect, either a five-wave pattern or a three-wave pattern. And if I zoom in on the A wave, this is 1, 2, 3, 4, 5. So this is the first wave, the second wave, third wave, the fourth wave, and the fifth wave. So guys, in this case, we got a five-wave pattern for the A wave and not a three-wave pattern. So the next thing is to get the B wave. So I'm going to dissect the B wave, and you guys will see the B wave is always a three-wave pattern. So with the aid of my trend channel, I can get the extremes of the correction of the B wave. So this is A, B, and C. At the end of the B wave, what comes next is the C wave. And I said the C wave is always a five-wave pattern. So this C wave is always a five-wave pattern. So with the aid of my trend channel, I can dissect the B wave and get the fractals properly. So we get trend channel. This will give me the. This gives me the. This will be first wave, second, the third, the fourth, and the fifth wave with a different color. Red. Green color. So this is the first wave. What comes next is the second wave. You can see the retracement. This was the second wave. The second wave. And after the second wave, what comes is the third wave. So this is where the third wave started from. So this is the first, a retracement, second, third, fourth, and fifth. Since I've gotten the fractals of the first wave, the second wave, and the third wave, I can easily get the fourth wave. Now we just draw the whole thing so you can see. This is the first wave 1, wave 2, this was wave 3, wave 4, and what comes next is wave 5. Should get the fractals of this wave 4. This is it here. This is this A, B, C, and the next thing is this wave 5. So if you don't have the time to go down to the lower time frame, because the lower you get to the time frame, you know, to get the fractals, there's a very high chance of you making error. What you can just do is that you can say, okay, on the break of this structure, because this is a major area of liquidity. On the break of this structure at 25,25448.50, I will take a buy trade, because that means that once the market breaks the structure, it means that there's a change in the order flow of the market. The order flow has moved from a bearish move to a bullish move, because this break of structure signifies like a change in the sentiment of the buyers in the market. Why did I say that? If you look at it very well, the market has been making lower lows and lower highs. So this was a high, a low, a lower high, a lower low. So what to expect should be a lower high and a lower low. But instead, if you get a high or a higher high, higher than this, that means that shows a change of character, or a change in the direction of the market, and it signifies reversal. Now that is me explaining the market structure. But what's happening, essentially happening down here, is that at this area down there, you have, this was a protected high by the banks. You can see none of this high ever got broken. It never got broken because the banks sold heavily at each of this high. They sold heavily here, that gave rise to this massive bearish move, and also sold heavily at this region that gave rise to this heavy massive move. So if banks place a trade, they're always sure of the trades, so meaning they had a stop loss here. But if this market then came up and broke this structure, it means that the banks are no longer at this area. Their stop loss is no longer here. It means that they've taken their profit and they've led the market to go towards breaking their protected high in the market. So that's also one of the psychology behind it. And secondly, if you want to get a better entry, instead of you entering at this 25,448.58, you can still count the fractals of this fifth wave, because this is a bearish impulsive fifth wave. So you have to expect a 5-wave pattern. So if I get my drawing tool, I can get the fractals. This is the first wave, the second wave, third wave, the fourth wave, and the fifth wave. Now this is also understanding the market structure, but to understand the psychology behind this also is that within this fifth impulsive wave, you had a highs down here. Notice that at the end of the high, what came next is a sell, a massive sell, a high, and a sell. So meaning at this area, you had stop loss placed above here from traders that sold the market. At this spot, you also have stop loss placed above here from traders that sold the market towards getting this, that led to this bearish move. And similarly at this area. So what that happens, that stop loss is like a pool of money, what we call liquidity. You have liquidity resting above there. You have liquidity resting above this area, and you have liquidity resting above here. So the banks, they're always after your liquidity. They're always after internal liquidity, because that's what they use as a catalyst towards moving their trade, towards pushing their trade towards their direction. So what happens is that they're always after this liquidity. So the market is going to come when it has gotten a form of support around there. It has broken this fourth structure. This structure you could see down there, which then signifies that we're now in a bullish move, because there's a change in the sentiment of traders in the market. So that's moved from sell to buy. So you can see this minor structure. So you can say, okay, on the break of this structure before it happened, I'll take a buy position. So what banks do is that they're going to go upward, clear out this money resting above this region, clear them out. So to clear out the stop loss, so you can see when the market got to this area, it attained a form of retracement and it continued. So that is the banks clearing out the money resting above there. Also, they will clear the money resting above here, and this is the final end of where they're actually after. So when they come off, they'll clear the money or the liquidity resting above this and mitigate their position. When I say mitigate, the banks, before they took this buy position, they sold the markets first before buying. So they have an open sell position that is running at a loss, even if they were at profit around this area. So what happens is that they have to, when they've cleared this liquidity that was engineered by institutional traders, they will go downwards and mitigate the position. So they'll go downwards and close their open sell position that's around this area, or some people might call it the order block, like break and retest of an order block. So it will come downwards and retest this order block because you still have open sell position. What was an order block? Another block for a bullish move is the last bearish candlestick before the upward move, So this was the last bearish candlestick. You can see the last bearish candlestick. So this is an order block. So it's gonna come what? Clear out this liquidity and mitigate. So if I should draw what's gonna happen, it's gonna be like this. What will happen, what to expect will be market going upward, clear out the whole money, resting above here, there, and there. And when it does that, it will go downwards, mitigate its position, and not break. It will never break this structure. It will mitigate its position. Then the next target will be at this level down here, because at this ends at around here, the banks also sold heavily around this region that led to this whole massive sell. You can see the sell. So you have the stop loss placed above this area. So the banks are after liquidity, like I said. So the stop loss resting above here will be in form of liquidity, will turn into liquidity or turn into pool of money. So to come there, clear this money resting above there, mitigate its position, and head for the next target, which will be at the extreme high. So if I to get this, draw this down, extreme high will be this, which is this down here. So basically you have money resting at major swings. So you have money resting down here, you have money resting down here as a result of the banks selling down. So they sold heavily at this spot that led to this massive bearish move downwards, which was the correction. So you have the stop loss placed above when you sold, and that led to liquidity. And secondly, you also have retail traders. That see this as area of resistance, and once it gets broken, breakout traders, they place their buy stop at this area with their stop loss placed below. So that the stop loss from retail traders and the stop loss placed from institutional traders constitute liquidity around this area. And also you have liquidity placed resting around there as well, because the banks also sold heavily at that area. So like I said, the market will come upward, take out this engineered liquidity down here, mitigate, go upward and target this next liquidity resting above here in form of stop loss, then to go down and also head towards this area, which is the final end. So your first profit target should be at this place. This should be your first profit target. If you are to take a buy, if you are to take a buy trade, your first profit target should be at here. Second profit target should be around this area, and your third profit target should be around this area. So in summary of my analysis, this is the first wave, the second wave, the third wave, the fourth wave, and the fifth wave. And I said it's a flip zone because a flip zone is an area of resistance that turned to an area of support. And as you can see around down here, the market respected this area and it attained a form of support around this area. And when a flip zone is tested one or more times, it becomes a significant area of support or resistance. So this area of support this area of resistance turned into an area of support that gave rise to this massive move. And now the price came downward and it attained a form of support around this flip zone or this significant area of resistance and support. And like I said, by going down to the lower time frame, that gave us confirmation that we're already in a massive bullish move, and that this is a retracement. Is an A, B, C retracement, and at the end of the retracement, what comes next will be a massive bullish move that will take out the liquidity resting above here to go down, mitigate, take out the next liquidity resting above this area. It will mitigate and head for the next final target, which will be at this area. Should be your final target, your first profit target at this end, and your second profit target at this end, and this should be your third profit target, and your stop loss should be placed at the last low of the market, which was there. If you go down to the lower time frame, you can see it properly, but this is just a summary of my analysis. Thank you guys for watching this video. If you like what you watch, don't forget to like, comment, and subscribe. See you guys on the next episode. Thank you.